record. Hi, everybody, and welcome to From the Research Chair. This is episode 12. It's kind of a holiday edition of this podcast. I think it'll be the last one until after the new year. Happy holiday season, regardless of the holiday you celebrate. I'm Jason Voss, and that is
Michael Falk. Happy holidays.
Michael Falk, the lion tamer, no less. Michael, why did we choose this topic? Why are we discussing this?
Inclusivity. More to the point, so many investment teams that Jason and I have had the privilege of working with, investment firms, wealth management firms, they just don't share or acknowledge or respect their appreciation for the package deal of the entire organization, operations, if you will, distribution, if you will, investment management. If only those three different distinct divisions, they all matter. And respect them all, appreciate them all, can lead to better results.
I think that's a great answer. For those of you who don't know,
I should sign off now.
drop the mic or the lion stick or whatever today's theme is. Return to the Active Manager, which I co-authored, a book that came out last year. This theme features large. It's been my opinion for a long time, dating back to my fund management days, PM at Davis Appreciation and Income Fund, that alpha is bled out by not managing all these relationships well. And I think we're going to hit some of these today. And I think, and I'm going to risk speaking first here. I bet Michael, you'll chime in. A lot of firms that I have worked with over the years, they found it in the same way. Typically, there was a dare I say, old lion investor who had a high level of skill that was demonstrated either at a sell side firm and was like a prop trader, or they came from another mutual fund background, and they left and they started their own firm, and it was all about money management, and distribution was kind of an afterthought. They thought performance would sell for itself. And then as they attracted assets under management and things got unwieldy, they started bolting on these other departments to try and solve problems. And there is a lack of cohesion. There's not really a firm. There's a money management department with bolt-on appendages, and there's a lack of or there are too many seams, I should say, between these departments. Rather than being seamless, there are jagged seams. And what ends up happening is as the firm scales up, alpha starts to sort of go out the door, not just due to investment performance, but a lack of cohesion. Michael, I saw you nod and say something.
Well, I just want to say yes, and there's one little word that you left out really early on. You said, they left because of their skill to hang a new shingle, right?
Yeah.
Skill or ego.
Yeah, sure, of course.
You forgot the words or ego. And the reason I bring that back, sometimes it's skill and ego, right? The ego, when they start to bolt on the other pieces, just as Jason talked about, they have a very different perspective on where those pieces kind of sit or stand in the pecking order. And that is largely an ego topic, not a skill topic per se. So yes, and those comments.
Oh yeah, ego definitely factors in. I've never met anybody who started their own money management firm with that who did not have a healthy dose of that. And
and that is the positive side of overconfidence. I'm so sick and tired of everybody saying overconfidence is a bad thing.
Oh, in fact,
without overconfidence, would anybody start up a new business of any type or industry? Can we just have a little appreciation for overconfidence not being pure evil?
Hope be a drug, my friend. So let's take these department by department per the outline of the invite to the podcast. Let's talk about human resources first. Michael, how is alpha created or lost in HR, in your opinion?
Well, if only we want to perpetuate the myth that HR is responsible for the care and the bringing in of talent and the care and feeding of talent. It's more true than a myth, but let's think about this. If investment management is really decision making ad nauseum, which means over and over and over again, lots of individual factor type decisions, what to
second by
research,
second.
how to research, what to buy, how big to buy it, when to, it's all decisions.
What to do with this news story?
Yes. So if we want to optimize a decision-making team, there's wonderful research on how big the team should be, how diverse the team should be. And I mean diverse from cognitive diversity specifically. I'm good with the other forms of diversity too, don't get me wrong. But since we're talking about decisions and thinking, I want to focus on cognitive diversity. The human resources, the talent, finders, keepers, growers, are they interviewing for these things? Or are they actually searching under the wrong topics? Are they recognizing that young talent wants to be developed? Help them, because investment managers are not frequently enough good at developing younger talent.
Oh,
I'm not saying they can't.
Boy, howdy,
it's not a
are
focus.
Yeah, they're terrible at it. Yeah, most.
All right, well, I'm being a little bit more gentle. So human resources has been given the responsibility to do these things. And oh my God, are they important to the investment team's health over time? So they are absolutely a part of the alpha.
Totally.
Jason, is that okay?
Yeah, and I'll add, because I think that's a almost complete answer.
I needed to leave you a little space.
Yeah, I'll see your ego from the previous discussion and raise you with my add-on. I think that one of the failures of most research teams is to know how it is that they're actually adding value. And I'm not talking about in terms of process and execution. I'm talking about the mindset of the people that are successful investors. Do they know what it takes to have it? And I think it's a very difficult question to answer. I don't think it's impossible, though. And I don't think that a lot of research teams have ever sort of slowed down to codify that. So even at the individual level, there's a lack of understanding of how it is that I've become successful. What is it about my thinking and makeup has made me successful? I'll give you an example. Shelby Davis, who was the founder of the Davis Funds, along with two other partners way back in the day, 1969, I think was a genius investor. And I mean, he's still alive, so he's still investing. So I can't evaluate genius or not, but well, I'll grant him permanent title of genius. I don't think if you ask Shelby, I don't think if you ask Warren Buffett, what was the source of your success, they'll talk about process that naturally flowed out of their thinking, but they won't be able to tell you what. And so I've tended to think that the best investors have a really good balance of analytical and creative functions, or analytical and intuitive functions. And I think that's a big deal. So my point is, if you're working in a research team and you want to improve alpha, you should spend a little bit of time with your HR department actually mapping what it takes to be successful. Your HR department then can be on the hunt for the correct skill set and begin referring talent to you. The other part, and I'll amplify a point you made, Michael, about diversity. I did an article for CFA Institute, and I looked at the percentage of our industry in the upper echelons, portfolio manager, chief investment officer, CEO, founder, whatever, that came from the Ivy League schools here in the US or the English or European equivalent. And it's something like 65%. And they're educated by the same handful of professors and the network is the same, and the recruitment practices on the front end to get into those schools is the same. And I think there's a tremendous lack of diversity in our industry. And I think we have a bland sameness. Joseph, you work in manager search. I bet a lot of these firms are really hard to distinguish when you talk to them. And in fact, there are, I think, a lot of subconscious rewards for aping the behavior of what it takes to be an investment pro. I used to go to the CFA Institute conferences, and I was, it's like it's hard to distinguish people after a lot of those conversations because we all look the same. We're all white males typically for starters, and we all kind of think and breathe the same way. There's not a lot of diversity there. Anyway, I think HR is a source of alpha, both in terms of continuing education, continuing professional development, as well as on the front end, get the right people in the door.
Yeah, I mean, even if it's only, Jason, to stop the investment team from perpetuate the hiring of people who are exactly like them.
Yeah. Psychological projection writ large. And you and I have worked with teams where there's the founder, the lion, the old lion founder, and the Cubs. Boy, are they similar to the founder. There's not a lot of variety there. It's not universally true, but it is a truism, I think. The other thing,
the reason, let's be clear with everybody, the reason we wanted to start with human resources is because I think they're number one on this hit list of importance.
I'm going to disagree with you on that. I'll get to my favorite one on this list here shortly, and I think it's kind of an unexpected one, but which comes second.
Well, I quite like operations too, but all right, let's move on. Let's go to the next group.
One last comment on HR for value add for Joseph and any other manager search people. The absolute gonad crusher question I used to ask candidates that were wanting to be research analysts or even interns.
There could be kids watching this YouTube at some point.
Well, I was trying to be universal and biological, right? So ovaries and testicles are included in gonads, so I wasn't saying the ball crusher question. The question
like you just did.
Right, of course. The question I had to ask, or I asked folks, was, what do you do that's creative? Talk to me about how creativity enters your investment process and what you do. That was a soul-crushing question for almost every candidate I ever interviewed. Joseph, throw that one to your mix. Don't make it a part of your investment decision-making process because you will not get a good answer to that question. But that is...
Joseph, I got a killer for you. Are you ready? Tell me about an investment you made in the past that was brilliant beyond your initial expectations that you don't think you'll ever be able to find again.
Also a great question.
Hate it.
Oh, absolutely, they hate it. Going back to the creativity question, though, that one is important because if they have a good answer there, it says they understand how they're adding value, and they usually don't. They think it's due to their screens or some sort of quant skill, or we turn over the more rocks than anybody else, blah, blah. You've heard it all. Next up, transitioning, distribution, Michael. To me, this is my number one. I think this is where alpha has really bled out of the firm much more so than
too
HR.
Easy.
Do you want to go first on this one, or you want me to?
Sure. Well,
there was an or question. You can't say sure.
Well, it's these are the promise makers, right? And then they let everybody else back in the company be the promise keepers. All right. The distribution folks, if they can be coach, if they can be counselor, if they can be informed by their investment team, what they can do with clients or prospective clients is magnificent, right? You've got an incredibly talented investment team that sticks to their knitting, but they do evolve over time as they need to stay current and competitive. But they're out of favor for a period. The distribution person can help keep the assets. Maybe they raise assets during that time to help. The reality is, and the industry hates to acknowledge it, your investors, when you're an investment manager, your investors are your partners. And the reason I say they're your partners is because when they give you money or take it away, they can hurt your performance. And if they can hurt your performance, you sure as heck better think of them as partners. So your distribution people, they are the tip of the partnership. They are the ones maintaining it. It's truth, it's information, it's counseling, it's keeping your clients informed. It's all that, Jason. So I'm a big fan of this topic. It's just too easy of a choice. to make number one.
Who for I guess we're forbidden in a Judeo-Christian tradition from having stuff be easy, right? Easy necessarily means sinful, right? No, I think distribution is the correct choice because it's about the psychological contract or the written contract between the customer and the actual company. And the easiest way for me to tell my version of why I think distribution is the most important at the Davis Funds, our distribution group I thought was outstanding. During the dot-com bubble burst, we actually had net client inflows to our funds. Oh my God. We were one of two firms of scale that actually had that as an outcome. And it's because our distribution team really understood the product. They understood who we were as investors, and that's what they sold over and over and over and over again. And they knew that we wanted, as investors, capital inflows in a market decline, and that's exactly what we got. Now, that said, at our firm, the distribution team, much to my surprise, would report that I was the most accessible of the portfolio managers. Little did they know it's because I just like to gab. But the other PMs, the other research analysts were less accessible. And I thought that that was a missed opportunity because the distribution team is out there selling these funds. And it's really important, really critically, crucially important that our end clients are served. And the way they're best served is if they understand the products they're in, and they're also best served when that alignment is really in focus. Investor, intermediary, that could be distribution, it could be folks like Joseph, it could be the pension fund, but the end client matched with the people making investment decisions, that's got to be in focus. And distribution is really where those conversations take place. That's why.
And let's people know this, but it just needs to be repeated more. Unpopular, out of favor markets for a talented investment team is where all the wealth is created long term. That's where the real money is made. And it takes a bit of a strong stomach sometimes to do that, right? So Jason, can we move on to the next group?
I want to add something to the distribution. This is how this works for those of you who haven't seen Michael, me before, and our clients can report this. We ping pong out off of one another. I think that the other wrinkle there to distribution, I think that it's really important at the firm level, I'm talking about the C-suite level, to grant your distribution team the ability to say no to assets. That rarely happens. Rarely happens because the business mandate is to grow AUM. I'm sorry, if I had a beep, I would beep out the cussing I am about to do. The growth mandate in AUM via marketing is one of the great sins committed against our end client. That does not serve the end client. The end client doesn't care about growth in AUM. What they care about is investment returns. And to be able to turn away money because they think a class of investor is a misfit for the organization best knows its investment philosophy, and they ought to be charged with, the distribution folks at the front door, to say, you know what, you're probably not the right investor for us. These are some firms that we respect. Why don't you go take a look at them? And that's my final comment there.
Yeah, well, the distribution people, as I said earlier, they are the tip of the partnership relationship. They are the only ones, or rather they are in the best position to assess that person is going to make a good partner for me and my organization.
Agreed.
So do it.
So
next.
Well, next we were slated to talk about the board, but I'm going to slip one in here, because I'm a 7 in the Enneagram, which features large and FCG work. I'm a creative kind of a guy, and I'm a tail puller and a rule breaker. So the one I'm going to slip in here.
You're bored by the board?
Not bored by, well, sadly, I am usually bored.
Most boards are a bit boring.
They are a bit boring.
Because they all look the same.
They do all look the same.
People.
We'll get there in a millisecond. Accounting department is one we left off of our list, which I think is another missed opportunity.
Did you say accounting department?
I did say the accounting department. And here's...
You're on your own here, man. I'm not going there.
Okay, so I'll be quick. Here's where alpha is lost. And again, a part of Joseph due diligence. Sorry to pick on you, Joseph, but I know your background. And not really picking on you, trying to use you as an example. As a fund manager, a lot of the time, and true as a research analyst too, you're flying blind with regard to the components of your performance. And when I first started at the Davis funds, I was shocked by the fact that all we got at the end of the day was a little email that said how we performed on an absolute basis and basis points relative to our benchmark, which was the S&P 500, and we had broad indicators in how they'd moved. That was it. That was it.
You're raising the benchmarking topic and calling it accounting?
Well, hold on. So I thought that was a piss poor use of our accounting department's expertise. These people are used to gathering data, synthesizing it, and putting it into a digestible format. So I actually worked with our accounting department to create a report that was of use to me. And that report then showed me at a very granular level a bunch of information, which still remains proprietary and part of some of the work that Michael and I do with investment teams. Michael, you've heard some of this. And I had my accounting department, and I asked for a staff member who I thought was really bright to help me develop this report. And I got feedback on a daily basis as to the really nitty-gritty stuff I cared about as a fund manager, actually initially as a research analyst, and it helped me manage. And I don't think most firms have any version of this at all that they're utilizing, or if they do, it's underutilized. Michael, you and I just worked with a client this summer who has a person in that role, and I think you would agree with me, that person is underutilized.
Absolutely.
Yeah.
Absolutely. Yeah. The accounting label threw me. Maybe it may have thrown some of our wonderful guests. What if we refer to this as data, right? Whether it be decision inputs data, whether it be more useful attribution styled data. So I don't know if we want to take it all the way to a data scientist. I don't think that's fair or reasonable even, but accounting, I'm picturing a green eye shade, not really useful, productive, twisted and tortured data to get more insight.
My person at Davis Funds was one of the fund. There were two people who did the fund accounting, right? So they were responsible for calculating NAV, net asset value, each day, and that was one of the people I borrowed. And they were in the accounting department, and that role, the feedback role, that hey, I'm writing. It's like without this, you're riding your bicycle by staring at the front wheel, right? If all I get is relative to performance to a benchmark, I have no horizon view of any use, in my opinion.
But I'm not going to drive into a hole in the ground and crash.
They do, though.
I did on a mountain years ago.
Because
I didn't see the damn hole in front of me because I'm looking down the mountain.
Yeah, understood.
So careful about that.
Next, the not so boring board. Michael.
The board. So I want to recharacterize the board for just use of my descriptor here, parent and child, right? The board essentially is supposed to be the adults in the room. So we'll call them the parent, and then all the employees, regardless of what division they're in, what part of the organization they're in, those are the children. All right, I know, I don't mean, this is not intended to be demeaning in any way, so please, I'm not trying to be facetious.
Because you usually announce.
Does the parent enable or disenable better behavior, improved focus, levels of autonomy by the children, the creatives, the people who are making the donuts every day? The board applies pressures, sometimes explicitly, sometimes just implicitly. Those pressures do not help. The board needs to make sure that there's strategic direction about the organization that people are informed about, right? To Jason's last topic, right? What's on the horizon? What are we thinking about? So those are just a couple of real quick hit thoughts, Jason.
Yeah, I don't have much to add there other than again, at the point where a firm gets scale enough that they're even thinking about the board in a thoughtful way, they usually punt. They're just trying to, they'll bring in friends and family or acquaintances to sort of manage that relationship. And you'd be surprised. And those of you who have actually scratched the surface of this, most boards in our business lack independence, or, and now to the point of where alpha is lost, helpfulness. Most of the boards serve a governance function, but not it's monodirectional or unidirectional. They serve as the gatekeepers for the shareholders, which is great. They should. But in terms of alpha generation, very frequently the board has their own outstanding experiences and networks, which are rarely tapped by the fund management team or the research team, because they don't think to ask to do so. So one of the things that I know, having reported to a board for a number of years, is I loathe the board meetings. And the reason I loathe them is because they were boring. And what they meant for me was a lot of distraction off the management of my fund to help prepare a board book, which was whatever the biggest 3-ring binder used to be. It was gigantic. But the most use I got from the board was at the board dinner, which was always historically the day before the board meeting. And I had conversations with the board about what's the direction of business. A guy who served on our board had been a guy named Jim Guzzi, who was one of the co-founders of Intel. And oh my God, what a great conversation that always was. And boards ought to be tapped in that way and be bidirectional. I think it's entirely appropriate for the research staff to ask the board to make introductions, to provide strategic insight, to your point, Michael, to provide a rendering of, hey, what's the general macro view and business landscape point of view? And that's never really engaged in my experience of doing due diligence on these types of things. The board is seen as a thing I have to check off, and that's the extent of it.
I have to share a board story because it just is priceless. Many, many years ago in a former life, a partner and I were about to be named or being considered to be named a sub-advisor to a 40 Act mutual fund for some specialized work that we did. We were asked to present to the mutual fund board. I was warned, my colleague was warned ahead of time that this board may be different than other boards that we may have experienced in the past. To which I asked, different how? If you're going to go there, at least give me a little insight. His comment back to me, they're all old friends of the patriarch. Almost none of them actually understand the business. You'll be clear on that when they start asking questions. And usually one or two of them doze off during the course of the meeting. 2 guys dozed off during the presentation. The good news is I didn't take offense to it because I was briefed ahead of time. One of them, or both of them really, kind of woke up during the Q&A and then asked a question. This board, whether we were right or wrong for the organization, this board was damaging to the organization. All right, let's get off the board now.
Yeah, to summarize
Sleep through the meeting, then ask a question.
To summarize that section, alpha is lost there because it's a missed opportunity. The other point we didn't make is an uninformed board is also not useful because they can provide insight. And like, for example, September 11th happened on my watch as a fund manager, and it would have been great to be able to go to the board and say, hey, what do you have any advice for what the hell we do? And that there was no such conversation that was forthcoming with regard to our board. Michael, you had mentioned operations before. That had not made our bullet point agenda. That I have some comment on, but probably not as much as you. Mention operations.
The fastest way for any investment firm to go poof is a problem with operations. Nothing will kill a firm faster, has a greater ability to destroy a firm than operations. let me change the name and use a metaphor. Operations is the plumbing. And we know what happens when the plumbing gets backed up. Don't underestimate the value of the plumbing. Now I want to connect it to the data topic from before. Accounting, please. The data topic. Operations, they actually have all the data. Somewhere, somehow. Do they know? Do they have the ability and the skills to manipulate it? Can they actually feed it back to the relative teams, whether it be distribution or investments, to help them learn and get better? It's feedback. It's just feedback. The data doesn't know who you are. The data doesn't dislike you or like you. It's just feedback. It's like standing on a scale to see what your weight is. It's just feedback. Stop hating the scale. All right. The operations team, they keep everything fluid. Got to connect to the metaphor. They have the greatest ability to provide you with data that is immensely beneficial. I am a big fan of operations.
Give us a case study, so it's a little bit more tangible.
Compliance was an external function to a smaller organization that had started to grow up and see and achieve success in terms of gathering AUM and being able to expand beyond their flagship strategy. And they didn't have the operations infrastructure to have a real easily a second strategy to go with the flagship. Did they have the infrastructure to allow it to happen? At the time now they're starting to grow up and people are like, you need internal compliance. So they needed then to either elevate somebody internal or hire from externally, compliance lead. And all of this went to their ability to grow up from a small startup that actually earned success to become a going concern. So operations was everything to basically stabilize the business and give it an opportunity to grow.
Not to mention taking or giving back to a likely research-oriented founder his or her day to begin focusing on what their real genius is, which hopefully is investment management rather than investment firm management.
Typically is.
So compliance was next up on our bullet point list. My ad here on compliance is the prospectus. Prospectuses are an underappreciated, in my opinion, part of the success of an investment manager to deliver alpha. And
now,
I say
you've made me curious now. Nobody reads those, so how can you make?
Because they are the guardrails. They are the enshrinement of the investment philosophy. And they allow, if you understand as you join a research team what your fishing pond is and what the mandate is, that is your first and permanent filter for how you see all investment opportunities. If that document, the prospectus, is out of accord with the expertise of the investment team, you're going to have problems. Case study. When I first joined the Davis
prospectuses, is that right? Is it prospecti or is it prospectuses? What's plural?
Well, my friend, it depends on whether you consult the English or the Americans, and I don't know about the Canadians, Gordon, on this. The English, it's, I believe, an I. If it's the Americans, it's an us's. So there's platypi and platypuses, and both are acceptable, but it depends on the dictionary you consult.
This is a fascinating animal. I don't know how you worked it into this conversation.
Well,
all right. So
I will tie it back. I will tie it back. That's it.
I had a point.
I know. Well, so did I. I hadn't finished. That was the challenge. Here's the tie back. I managed a product that was heavy in convertible securities, which are the platypus of asset classes. And when I first started the Davis funds, it was called the Davis Convertible Securities Fund, the fund I managed. And over time, the convertible terms were so shite as to be basically impossible to deliver the mandate. And so we talked very thoroughly internally at the fund. What is it that we're really delivering? And what we're really delivering is asymmetric returns. 80% or more of the upside of the, capturing 80% or more of the upside of the S&P 500, 50% or less of the downside. And so we changed the name of the fund to Appreciation in Income and expanded the mandate and the prospectus to be in accord with what was actually the core investment philosophy. Without that, it would have been really hard to deliver for end clients what our promise was. And I think that compliance, most firms, again, check the box, here's the prospectus, and then they move on and they get busy with the job of managing the money. That document has often never been revisited from the initial year that that product was offered. But Michael, you said something earlier quite interesting: evolution. Does the world evolve? Does the world change? Yes. Do investment philosophies also have to? Yes, absolutely, because the world does change. It is in flux. And yet the prospectus is the enshrinement of the old values and the old way of thinking. The compliance department, and I'm pleased to say the one at the Davis Funds was outstanding. They actually made us aware of developments within the industry and what our competitors were doing, and they would adjust our prospectuses routinely so that we could execute a mandate in a competitive fashion.
Two thoughts. All right. First of all, you just used prospectuses, so I'm going to stick with that versus prospecti. Over the years since you managed that wonderful portfolio, they have become written so generally, so inclusive, including everything under the sun. I submit they are of absolutely no value. So that's the first comment. Today, I'm being specific. The second comment, here's my appreciation for compliance people. See, some people in these organizations, they happen to see compliance people as the people who always say no, right? This is not uncommon. I happen to view compliance people who acknowledge that, Michael, you don't look good in pinstripes. Keep me out of orange colored clothing. Compliance people are not there to tell you no. Compliance people should be constructive, helping you understand how to not get in trouble with the law and help you understand your guardrails and boundaries in a productive fashion. Compliance people, from my opinion, when they're good, when they're not the no, when they're not those compliance people, can be immensely valuable.
So that is the end of our bullet point list. However, I think we should summarize here with some insight. And I've got an analogy that I think will also illustrate this, but I'm going to save that. Michael, I'm going to give you the chance. You've done this kind of work, working intimately with investment teams longer than I have. Who's to blame for the firm not working well, typically?
The leadership.
We haven't talked about the leadership. So leadership oftentimes is the same as the research people, sometimes not. And this is a leadership issue.
Founders or quasi-founders, often, yeah.
And so our admonishment and our suggestion simultaneously is alpha is not just picking the right securities and hoping they go up and seeing them go up. It is managing the firm well. Agree?
Yeah, and more generally, this is about structure, right? We all know that if you have a good structure, it allows everything above that structure to work well. If you have good leadership, they're setting a quality structure or not, and they will enable the rest of the firm to work well. Leadership is critical. And unfortunately, and this is not a negative on the leaders, unfortunately, they were talented professionals from some perspective, whether it be investment management or asset gathering. Those are the two typicals that we see, right? Salespeople, distribution. Typically, they were unique talents. They became leaders because they were unique talents. They had greater tenure. They had more success, whatever the case is. but they never learn leadership skills along the way. And I don't believe in the crap that leaders are born, not made. No, everybody can learn leadership skills. Yes, some people will be better than others at it, but just because you're a leader doesn't mean you know anything about how to lead. Leaders can only lead to the extent that people want to follow them. Get some skills, skill up if you don't have them, because you are going to be the structure that will enable or inhibit the success of the rest of the firm.
Totally agree. Nothing to add. My analogy comes from Joe Morgenstern, who I think is one of the most gifted writers I've ever read.
I'm a fan.
He's the film critic for the Wall Street Journal, previously of Newsweek, I think, and I love his writing and his critical eye and how he dissects stuff. In any case, he wrote this really interesting piece one time about the difficulty of creating a great movie. And he said it's a minor miracle every time there's a great movie, and we should pause to celebrate a great movie because of all the interrelated parts. There's the casting director, this version of HR. There's the cast itself, all right, that's obvious. There's the producer, there's the director, there's the craft service people, the location scouts, there's the distribution service. It's all there, and very similar to a mutual fund in terms of, or a money management firm in terms of its structure. And I think one of the reasons active management struggles relative to passive that's underappreciated is it is a minor miracle.
You don't like the word passive. Index.
Okay, all right. Well, index.
Don't perpetuate the false myth. There's nothing passive going on.
Yeah, and thank you for correcting me because I've written about this too. But nonetheless, it is a minor miracle when active management is done well. And I think the mistake that is made by the research staff predominantly and the leadership of firms is to think if we just pick the right securities that go up, that's the only thing we need to do. And just as it's not enough to hire Tom Hanks and a great director to have a great movie as output.
The words minor miracle, they concern me a bit, Jason. because if there's an active manager who does succeed, is there the chance of a God complex?
Oh, Michael, I think you're overreaching here, my friend. We just worked with a client where we didn't say it, but I think you would agree they were one of the highest quality firms we've ever worked with, and they were a minor miracle. And because multiple parts
of that's because they're in the minority, because not a lot of firms have that level of quality, talent, thinking from our perspective.
So it's a minority miracle. Now, are you happy? We had the
I'm better with that. I'm better with that. Yeah.
All right. Well, we have time for some questions, and if not, we'll wish you happy holidays and talk about the next time we meet. But we've got some time for questions if anybody.
And by the way, the next time we meet, we have something special on tap.
Yes, though not confirmed.
Although it's going to be in January.
Yeah. Though not confirmed yet.
It's audience participation time. Jason doesn't bite.
Michael, presumably you do.
Well, I just didn't claim.
So we will pause there. We'll start talking about the next episode. Frequently what happens when we start talking about the next episode, and as the scarcity bias, right, the doors closing bias kicks in, people inevitably will ask a question. Our next one is going to be January the 7th. We are hoping to have, though not confirmed, one of the few people that Michael and I believe is signal in the vast noise that is investment commentary. And a mutual friend of ours, Joaquim Clement, who is a gifted writer and a hilarious human being, but most importantly, he's insightful in how to do investing better. And he just published a monograph for this Research Foundation CFA Institute. And he and I co-authored a research brief for the CFA Research Foundation that will come out in the first quarter on stakeholder capitalism. Indeed, and I'm guessing we're getting some renown, Michael and I, for the far-ranging nature of these conversations. With JK, as I call him, introduced into the mix, it's going to be perfect conversation for the new year, right? Like breaking in 2021 on a fun note. Last chance for questions. If not, we'll wish you happy holidays and adjourn. Oh, there's a
Oh, we
question.
got two. Joseph raised his hand and Matthew chatted one in.
Oh, Matthew did. I just opened it up. What sort of incentives have you seen firms successfully put in place for salespeople to ensure that they are only bringing in the right type of clients?
We're on the same page on that one.
Oh, good. Well, so since we're short of time, that both people synced up on the question. Well, here's a couple playful ideas. Only pay them for bringing in assets when you're out of favor. It's got to be net asset sales over a period of 3 years. So there's an annual, but there's a little bit of a holdback that can only be paid out over 3 years. We have to incentivize them for producing the types of behaviors that are beneficial to alpha.
Vintages is my answer. So at the Davis funds, I never saw the actual contract, but I knew from conversations with distribution, they were incentivized by individual years and they were treated as vintages. You brought in X number of assets in, say, 2003, and you get more money and your bonus grows the longer those assets stay with us. And that was in part on the research staff. Obviously, if we delivered poopy results, then money would probably leave, but it's also on distribution. The other incentive, it's not really an incentive, but power that you would want to see in place is the veto power granted to the distribution team to turn away hot money or incorrect money. Rarely seen, but there are some firms out there that have that in place.
Yeah, I like the counter-cyclical commission structure based upon cash flow when you're out or you're in favor. The other thing, Jason, you brought up correlate vintages. I quite like that. That's actually something I've talked about as an asset management pricing scheme, in that the longer a client is invested with you, the lower their actual asset management fee goes.
A nice idea, and one I would support wholeheartedly.
Yeah, again, we need to work to twist, turn, shift the incentives to actually benefit the partnership that I've mentioned several times.
Yeah, and left out of this discussion because it's only an hour, but distribution is my pet topic here. It's almost a challenge to not just cry. I think one of the
But that's for laughter. That's not from
another missing aspect here is proper education of the advisor network that sells these things. So it's not enough to have a wholesaler that's properly incentivized. Who are these advisors selling this stuff? And are there opportunities for advisors to understand the products better? The industry doesn't fail on that one as much as I think it takes place at other parts of the value chain or the disvalue chain. But that's another one. I think that advisors also have to be informed and qualified sellers of the products that they're offering too. And all too often they're just, it's part of the Morgan Stanley platform and they're a Morgan rep, and so they just sell Morgan product. That's not so good. Better that they understand why it's there and what part it plays in a client's overall success. Are there any?
Yeah, and that's the big change. The big change for distribution is, hey, respect, generally speaking, your relationship with your client. You're a piece of their overall portfolio. You should have an understanding of what else is in their portfolio, because it could affect you. Wouldn't it be nice? Why wouldn't you understand, hey, tell me about your overall portfolio, because I may have other thinking that can be beneficial for what you're doing with me.
Indeed.
Stop being product sales.
Any other questions? And Ricardo, thank you for your comment. Graham, thank you for your comment. Appreciate that. Any other questions?
We are done.
We are
Put
done.
a fork in us, Jason.
Fork. Happy holidays to everyone out there. We will see you in the new year. And thank you very much for tuning in, not just to this episode, but I know many of you on here today are quite loyal. Each week we look at who registers for these things, and some of you, Alam, have participated in every single one of these, but for one, if I remember. You actually sent us a note of apology, which was very sweet. Nice to see all your faces, and we really appreciate your interest in what we have to say. Thank you.
Cheers all. Happy holidays.
Thank you both.
See you in January.
Bye.